The Federal Reserve, often referred to as the Fed, plays a big role in the economy. One way it does this is by influencing interest rates. This impacts how much you pay for a mortgage. The Fed doesn't set mortgage rates directly. However, its actions have a ripple effect on the entire financial system. Think of it like this. The Fed is like a conductor of an orchestra. The conductor guides the tempo and volume, which influences how the music sounds. The Fed's actions are like the conductor's movements. They guide interest rates and impact the cost of borrowing, including mortgages. One of the Fed's main tools is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. Why does this matter for your mortgage? Because this rate influences the interest rates banks charge consumers and businesses for loans. When the federal funds rate is low, banks can borrow money more cheaply. This often leads to lower interest rates on mortgages. Conversely, when the federal funds rate is high, borrowing becomes more expensive for banks. This can push mortgage rates upward. The Fed raises or lowers the federal funds rate based on economic conditions, which can have a significant impact on various aspects of the economy. They aim to control inflation and promote economic growth, ensuring a stable financial environment. When the economy is sluggish, the Fed might lower rates to encourage borrowing and spending, stimulating economic activity. This can lead to lower mortgage rates, making it a good time to buy a home or refinance an existing mortgage. On the other hand, if inflation is high, the Fed might raise rates to cool down the economy and prevent it from overheating. This can result in higher mortgage rates, potentially making it more expensive to buy a home or take out a loan. The Fed's decisions on interest rates are a balancing act, aiming to maintain economic stability. They strive for stable economic growth without excessive inflation, ensuring a healthy economy for everyone. Section 4, Basis Points. The tiny details, big impact. You'll often hear the Fed's rate changes discussed in terms of basis points. A basis point is 1/100th of a percentage point. So, if the Fed raises rates by 25 basis points, that's a 0.25% increase. While 1/4% might seem small, it can significantly impact your mortgage payments. For example, on a $300,000 mortgage, a 0.25% increase could mean paying hundreds of dollars more in interest over the life of the loan. Section 5. Adjustable Rate Mortgages. Riding the Rate Wave. Adjustable rate mortgages, or ARMs, are directly affected by the Fed's interest rate changes, making them a dynamic option for home financing. Unlike fixed-rate mortgages, where the interest rate stays the same throughout the loan term, ARM rates fluctuate based on market conditions, which can be both an advantage and a disadvantage. ARMs usually have an initial fixed-rate period, often lasting 3, 5, or 7 years, after which the interest rate can adjust periodically, typically annually. When the Fed raises rates, ARM holders often see their monthly mortgage payments increase as their rates adjust, which can lead to financial strain if not anticipated. Conversely, when the Fed lowers rates, ARM holders might benefit from lower monthly payments, providing some financial relief and potential savings. ARMs can be attractive for borrowers who anticipate their financial situation might change in a few years, such as expecting a higher income or planning to move. However, they also carry the risk of rising rates in the future, which can significantly impact monthly payments and overall affordability. Section 6. Understanding the Fed's influence. Key takeaways for homebuyers. While the Fed doesn't set mortgage rates directly, its influence on the overall interest rate environment is undeniable. The Federal Reserve's policies can lead to changes in the cost of borrowing, which in turn affects mortgage rates. Understanding how the Fed's actions can impact mortgage rates is crucial for anyone looking to buy a home or refinance an existing mortgage. This knowledge can help you time your mortgage application to get the best possible rate. Remember that the federal funds rate is a benchmark that influences other interest rates, including mortgage rates. When the Fed raises or lowers this rate, it can lead to corresponding changes in mortgage rates. Changes in the federal funds rate can affect mortgage rates, making borrowing either more or less expensive. This can have a direct impact on your monthly mortgage payments and the total cost of your loan over time. Basis points, though seemingly small, can have a significant cumulative impact on your mortgage payments over time. Even a slight increase in interest rates can add up to thousands of dollars over the life of a mortgage. Adjustable rate mortgages, or ARMs, are particularly sensitive to the Fed's rate changes, as their rates fluctuate based on market conditions. This means that your monthly payments can vary, sometimes significantly, depending on the Fed's actions. By staying informed about the Fed's actions and understanding their potential impact on mortgage rates, borrowers can make more informed decisions about one of the most significant financial commitments of their lives. Knowledge is power, and in this case, it can save you a substantial amount of money.